In recent years, artificial intelligence has quietly entered the world of finance, changing how decisions are made in the stock market. What once required teams of analysts, weeks of research, and years of experience can now be processed by machines in seconds. By 2025, AI is no longer an experimental tool. It is actively used by banks, hedge funds, trading firms, and even everyday investors. This has raised an important question for anyone interested in money and markets. Can AI truly predict stock market movements, or is this idea just another technology myth? To understand this, we must first clarify what prediction really means in the stock market. AI does not predict prices in a magical or guaranteed way. It does not wake up in the morning and announce that a specific stock will rise or fall by a certain percentage. Instead, AI works by analyzing probabilities. It studies historical data, observes patterns, and calculates the likelihood of different outcomes based on what has happened before. In simple words, AI does not tell the future with certainty. It helps investors make smarter decisions by reducing uncertainty. AI systems analyze massive amounts of information that no human could realistically process. They study years of stock prices, trading volumes, company earnings, interest rates, economic reports, and global market behavior. Some advanced systems even analyze news headlines, financial statements, and public sentiment to understand how emotions influence the market. By processing this data at high speed, AI identifies repeating patterns that are often invisible to the human eye. Over time, these systems learn how markets usually react under similar conditions, allowing them to estimate what may happen next. One of the reasons AI has become so powerful in finance is its ability to operate without emotions. Human traders are often influenced by fear, greed, excitement, or panic, especially during market crashes or sudden rallies. AI does not feel these emotions. It follows logic, data, and mathematical rules. During periods of high volatility, when humans tend to make impulsive decisions, AI systems remain calm and systematic. This emotional neutrality gives AI a significant advantage in short-term trading and risk management. By 2025, AI is already deeply embedded in financial markets. Many hedge funds use AI models to manage billions of dollars. High-frequency trading firms rely on algorithms that execute thousands of trades per second. Banks use AI to assess risk, detect fraud, and optimize investment strategies. Even retail investors now have access to AI-powered tools through apps and platforms that offer automated portfolio management and trade suggestions. In reality, AI is not replacing the stock market. It is becoming part of its core structure. However, the growing power of AI has also created unrealistic expectations. Some people believe AI guarantees profits or can always predict crashes before they happen. This is simply not true. AI systems learn from historical data, and the market does not always behave the same way. Unexpected events such as wars, political conflicts, pandemics, or sudden government decisions can disrupt markets in ways that no algorithm can fully predict. These events, often called black swan events, expose the limits of artificial intelligence. Another important limitation of AI is data dependency. AI models are only as good as the data they are trained on. If the data is incomplete, outdated, or biased, the predictions will also be flawed. Markets also evolve over time. Strategies that worked 5 or 10 years ago may stop working as new regulations, technologies, and investor behaviors emerge. AI must constantly adapt, and even then, it can still make mistakes. This brings us to the biggest misunderstanding about AI in the stock market. AI is not meant to replace human intelligence. It is designed to support it. The most successful investors and institutions do not rely blindly on AI. Instead, they combine AI-driven insights with human judgment, experience, and intuition. Humans understand context, ethics, and long-term vision, while AI excels at speed, data analysis, and pattern recognition. Together, they form a much stronger decision-making system. One of AI's biggest advantages in stock market predictions is its ability to analyze data in real time. AI tools can process massive amounts of market data, far beyond the capacity of human analysts, and generate forecasts based on historical trends and patterns. For instance, machine learning models can detect market shifts, identify investment opportunities, and predict price fluctuations with a degree of accuracy that has revolutionized algorithmic trading. Additionally, sentiment analysis tools can gauge public opinion by analyzing news articles, social media, and financial reports, providing insights that influence stock prices. AI is undeniably changing the way we approach stock market predictions, offering opportunities for greater accuracy, speed, and insight. However, as we embrace these technological advancements, we must also consider their ethical implications and potential for social good. The growing intersection of AI and sustainable investing presents an exciting opportunity to align financial markets with the values of responsible investors. Because investment strategies depend so heavily on your personal situation and goals, it's important for you to do your research before you commit your capital to any investment using AI or using your own manual methods. For everyday investors in 2025, AI can be a powerful assistant if used correctly. It can help identify trends, manage risk, avoid emotional mistakes, and improve financial discipline. However, it should never be treated as a guaranteed path to profit. Blind trust in any system, whether human or artificial, is dangerous in the stock market. AI should be viewed as a tool, not a replacement for learning and responsibility. So, is AI predicting the stock market in 2025 a myth or a reality? The answer lies somewhere in between. It is a reality that AI can analyze markets faster and more efficiently than humans. It is also a myth that AI can predict the future with perfect accuracy. AI does not eliminate risk, it helps manage it. Those who understand its strengths and limitations can gain an advantage, while those who treat it like a crystal ball may face disappointment. In the end, the stock market remains uncertain, complex, and influenced by human behavior. Artificial intelligence is changing how we interact with this uncertainty, but it has not removed it. The future belongs not to AI alone, and not to humans alone, but to those who know how to combine both wisely.